Hi everybody. Today I'm going to talk about the solution proposed by this book, The End of Banking, Money, Credit and the Digital Revolution, written by Jonathan Macmillan. Because it's surprisingly elegant and it tackles a big problem about the monetary and banking system today. That is, not only banks create bank money or inside money. I have to explain then how this book explains the monetary creation by non-banking sector, and then I will just read the solution that they propose to tackle the problems of limits in banking regulation that explains a big part of why it hasn't been able to prevent banking crises and bubbles and boom and burst cycles. So here's the question. Many of you already know that banks create money out of debt. Debt is behind the money creation nowadays because, yes, as you know, the central bank creates a little bit of the money we use, that is cash, for example, and also digital money that banks use that are called bank reserves. But the 90% of the money supply is bank money, is deposits created by the banking sector. And this is why, how? Each time that somebody gets a loan and it's in debt with the bank, this backs the deposit that the bank creates at that moment. Banks create money each time somebody gets into debt, each time somebody gets a loan, and these loans are backing the deposits, that the digital money that we currently use when we pay with a credit card or when we do bank transfers. And this is the most part of the money we use, and it's what causes inflation and so on. Okay, so this way the banks have the license to create money, something that is liquid, something that is kind of safe, at least it's backed by the state, so it kind of has this appearance, and it also is its value is regulated, it's constant, and it's the same and divisible. It's the same as the money that the state creates. So it has these three characteristics: liquidity, that is the promise that you can pay and use it and transfer it to another bank and take it in form of cash whenever you want. This is a promise that is also impossible to fulfill if everybody wants to do at the same time the same thing, but in normal times it works. It has the second characteristic, that is it's safe, because you don't believe that you are going to lose this money even if the bank crashes, because you know the state is going to rescue it. And so even if the system is fragile, because banks can go into default, they might do bad loans and crash, you know that the state is going to back it and rescue it, because it cannot afford people losing their money in the banking system and the trust in the banking system. And third, it has this useful thing that it's like money, you can divide it, it has parity with the real money. One digital euro is the same as one cash euro in cash form. So it has these characteristics that allow it to, even if they are passives from the bank, the promises of the bank promises is what we use as money, they have become the preferred form of money, and they become also, I don't know if legally or kind of a legal thing, not regulated thing, they have become legal tender as well, because you can pay your taxes with them and you can redeem debts with them. It's mandatory, it's acceptance by the population. So this is the normal way banks create money. They can create deposits out of debt. And it's regulated by you have some regulation that prevents that money create too much debt. For example, there are capital requirements that may say you have to have at least 10% of your assets backed by your own capital. That is, that even if you create a lot of deposits, if you have the 1 million in capital, that is money that I don't know how do you say. Well, the bank owners put their own money, 1 million. They may be able to lend 10 million euros, so they can create 9 million in deposits. But these 9 million in deposits cannot be more than 90% of the backing of the money they create. So it's a way to limit how much money they can create. There are also liquidity requirements that say to them that they have to have at least some amount, some percentage, a given percentage of reserves or cash. No, so this, so there we avoid a little bit a liquidity crisis. So these two requirements are the most important. They allow try to avoid a liquidity crisis. That is, too many people try to take out the money at the same time. This is the reserve requirements. The capital requirements allow to try to prevent a default, a crisis. If you made too much bad loans, you have a lot of losses, and you maybe you have to close the business. And this would be also a very difficult problems because some of the money that you created are promises that you are no longer able to fulfill. So people would lose money, and this is something that the state wants to avoid at all costs, because we need trust in the banking system in order for it to function properly. So these are requirements that limit the amount of money that banks can create. But when you have a boom cycle, that is, you are inflating a bubble, it can be an asset bubble like housing, or it can be a financial asset bubble like corporate debt, or whatever. Banks can sometimes create money in order to lend to a given market, and they are pushing the prices up, and this creates a self-fulfilled prophecy, and it gives a lot of benefits until it stops rising in price. So this way of creating bubbles are so profitable when they are growing that banks really want to lend as much as possible in order to earn maximum profits. So these requirements are something that limits their potential for creating new money to these sectors and to profit from bubble creation. So even if there are these limitations, or the interest rate that may at least real investments or real creating debt or creating credit for the real economy has a limit in how much it can grow and create wealth. So when you rise or lower the interest rates, this affects a lot maybe to the real economy, to the real sustainable long-term investments, non-inflationary investments that increase our amount or capacity to fulfill needs, giving goods and services. And this doesn't create inflation, but this interest rate or other requirements are not able to avoid the creation of bubbles, because they are so profitable that no matter how high the interest rate is, it's not going to be able to stop it. And that's what caused the 2008 crisis, and also another crisis in 2020 with the COVID pandemic and so on. Banks are all the time trying to the problem is this: the regulations doesn't work, and that's why we need a monetary reform that really avoids and stops bank creation of money. But even if we forbid banks to create money, there are other ways for them to avoid these regulations, and they are using them since 2000s and maybe earlier, and this also contributed a big chunk to the bubble that exploded in 2008. And this way of creating money, that is not by using the power to create deposits when you give out a loan, is what's called, at least in this book, is what's called the shadow banking business. Shadow banking are enterprises that they are not really banks, so they don't have to comply to the same regulation as banks do, so they don't have these capital requirements or they don't have these liquidity requirements, and they only operate on market constraints. If the markets are optimistic, they can grow a lot the amount of money they create. They don't have this ceiling that banks really do have. and when they can be very, very much riskier, very risky, much riskier than bank money creation, even much riskier. So we know banks are fragile. They use this fractional share banking that needs trust in the system in order for it to survive, to function properly. And shadow banking increases the risk taking because we know that markets are irrational, and when we have a bubble growing, markets just go for it. They seek short-term profits, and they don't see. They do this gambling thing, and they hope for the state to come to the rescue at some point. And this way they make a lot of profits, and that's why we have increasing inequality, and we have these financial markets that are like a big parasite for the real economy right now in all over the world. So, as you can see, it's very important to understand how this shadow banking business works and why it doesn't have these limits in regulating limits. It has another kind of limits, and I want to explain them and then present the solution that this book gives. So this is something. Banks do a kind of the banking business that does some techniques, which are the following. For example, they combine a lot of small amounts of money to give out different loans, and they mix them together, and this is important because if a loan fails, it doesn't matter because you gave so much loans that even if a little percentage fails, they are compensated by the interest paid by the other loans. So banks, for example, do this kind of thing of joining together a lot of loans and joining together a lot of backers. Really, when you have your bank your money in the bank, when you have deposits in a bank, it helps them finance their lending. It's not just direct, but it helps them. So they do this join together of loans because it reduces the risk taking. So as we are going to see, the non-banking sector, the shadow banking, does the same thing, because at the end, money is created again out of debt. What is back in the assets that then they become money because they have these characteristics of liquidity, safety, and parity with the regular currency. These assets that they create are all backed by debts. Debts are in the core of the money creation by the private sector. So again, we have a way for the non-banking sector to do the same as the banking sector, which is join together a lot of loans. And we're going to see how they do this, and then they are also able to create this safety, and they are also able to create this kind of parity and liquidity. And I'm going to try to explain it, and I know it's hard, and maybe you don't get it the first time, and maybe we need to do another video. Whatever you don't get, just put it in the comments that I will be reading them regularly. So this is how they do it. In order to avoid these capital requirements and liquidity requirements, what banks do is they create another kind of enterprise. This enterprise buys the deposits, the debts that the bank has given to people. Bank create loans, they lend money to people, and this is an active, this is an asset for the bank because somebody owes money to the bank, and these assets are transferred to these enterprises. So these enterprises have a lot of, in the asset side, they have a lot of debts, and in the passive side, they have a little bit of capital that normally the banks put there in order to have a kind of guarantee, so people that want to invest in this company knows that the bank is going to lose money if they made out bad loans. So it's a way for the banks to take responsibility for the loans they put in the asset side. But then the other part of the passive side of the capital, it comes from the markets. They sell in the markets pieces of the property of this enterprise. And this enterprise doesn't do anything. It only has these assets that are the loans that the banks transfer to it. Banks have a little bit of capital, and they expect the markets to buy the rest. So markets really can buy little bits or little parts of this company, which represent a big part or a small part of all the loans they created. So it's a way to join together a lot of loans and let the markets buy or be the owners of these loans. And they do this in a pyramidal process. Then these small pieces of the enterprise are joined together in another enterprise that has pieces from all over, from many different enterprises that join together many different kind of loans, and again and again. These are called CDOs, or collateral debt obligations, and these pieces of the ownership of these enterprises really are a way for people to buy debts that are joined together by this market process. So here we have something important. Why do people trust that these debts are good and they want to buy a part of them? They want to be the owners or the creditors, really. Because they know that the bank is putting a little bit of his money, like 10%, 20% of whatever amount they want. So if there are losses, if the loans are bad loans and they are defaults and they have to lose money and there are losses, the first one to lose the money is the bank. So by putting themselves first in the obligations of losses taking, they are taking the higher risk, and so other people can trust that these loans cannot be that bad because they wouldn't want to lose this money. So this is a way for the markets to be safe that these debts are good. And the more optimistic the market is, the lower capital requirements they are going to ask the banks to have. Markets can do whatever they want in this sense. So even if the bank has a smaller amount of capital, if the market doesn't believe there are security problems, it's a good time and there are not defaults in debt because the economy is doing so well and this bubble is increasing, nobody cares a little too much for these capital requirements, and so the banks can create more of these enterprises and join together more debts, and they can create more, they can give up more loans, and so this way they can avoid these capital requirements. But it depends on the market. If we have bad times, markets will ask for more capital percentage of the banks, and so banks could create less of these enterprises and could transfer less of their debts to this shadow banking. So this is the first part. This is called titulization, at least in Spanish is something like that. And it's a way to join together and let the markets invest in giving loans. So what are these CDOs? The CDOs are the collateral debt obligation. These are pieces that represent some loans, and many loans are joined together. Then we have an asset that is kind of safe because this by having the banks assuming first the losses, it's kind of safe, and these assets can be used for this second thing. So now we have another kind of enterprise, it's a different one, and it's called money market funds, like something like that. And this money market funds is a very strange business. You can have your money in the bank, giving you a small interest, for example, or even negative sometimes. Or you could move your money to this money market fund that gives you a little bit higher interest, so it gives you more benefits. And they promise you by contract that at any time you want, they are going to give you the money that you ask for. So they promise you liquidity, and they promise you parity with the regular currency, because it's not an asset that depends on market value and demand and supply or power dynamics. It only depends on a promise of this company, and they go full all in with this. We are going to give you can have 60 euros in the bank, or you can have 60 participations, 60 ownership part of our money market fund, and we promise you that whenever you want to change it for deposits or cash, you are going to be able to. So these money market funds give payment services, and they work very much like banks in this sense, that they allow people to pay each other as long as they are all in this money market fund, and when they are not, well, they can take the money out and that's no problem. So what do these money market funds do? How do they manage to get deposits whenever they want? Well, they sell to banks participations for deposits for bank money on this money market fund, and they have as collateral, as I don't know if this is the correct word, these CDOs. So the CDOs that the banking sector created by joining together a lot of loans serve now as a collateral for this kind of strange loan where banks give deposits for participations in the money market fund, which is a strange thing, and I'm not even sure if I understood it really well. I know yesterday I got it, but now I'm thinking a little bit about it. But anyway, I know it's something like this. So by having these CDOs as an asset that backs this exchange of deposits for participations in the money market fund, the banks can overcome some limitations and some controls on the amount of deposits they can create. It's something like that. And I know there is something called haircut, that is the difference on the amount of money and deposits. It's the difference between the value of the asset of the CDO backing the transaction in respect to the amount of money in deposits and participations of the money market fund that is done. So we have a limitation here. The higher the haircuts, the less money they can exchange, because the CDOs have to be higher in value than the transactions done in between money market funds and banks. So it's something like this. If the markets are optimistic, they can do a lot of this and they can increase the amount of deposits they give a lot, because they can overcome the limitations by buying money market funds participations. The other way around, if the markets think it's a bad time and they don't want to take risk, they are going to ask for higher haircuts. That is, the same CDOs back less deposit money market fund participation transactions, and so the factor by which it can be multiplied, the amount of money, is smaller because of this fear that it can go wrong, and so we ask for higher backing, higher value of the assets backing the thing. I know it's complex, I don't even get it completely. Each time I read it, I kind of understand it better. But it's something like this. It's by creating these enterprises, joining them together, then having this money market fund enterprise that does this kind of business and gives payment services, that the money market fund participations become money. And they become money because they are liquid. They promise you whenever you want, you can take your money out. They are safe because this join together and banking taking the higher levels of risk and so on. And it becomes at parity with the regular currency again. And it avoids these limitations of capital requirements and liquidity requirements. So they have contributed especially a lot to the crisis that we have by allowing the banks to create bigger to multiply by higher numbers the monetary base, the reserves and cash. They could lend much more than what they have, like 30 times more of the capital they put. You put 1 million to create a bank and you can lend 30 million or 50 million or 80 million. It has reached some of these levels, as a Positive Money video said. And now it's smaller because it depends on the market expectations. And this is the real driver of the amount of money in circulation, not the interest rates, is the market's expectations. And we know they are irrational, and we know they fall into bubble and boom and bust cycles every time. So what is the solution presented in this book, and why is it so elegant? Well, the solution is an account rule. It's just to say, we cannot create laws just dedicated to banking, and because we have all these enterprises that are actually doing the same kind of banking techniques in order to have the same kind of capacity to create money, which are these money market funds participations that serve as money for the richest people in the world and corporations and so on. So the accounting rule that they propose in this book is a rule that could be applied to every enterprise in the economy, making it impossible to have this kind of capacity to create your own money by debt, backed by debt. So you cannot create financial assets backed by financial passives. No, I don't know if it's the right word. Liabilities is the word. It's passive is in Spanish, pasivos. So liabilities, yeah. So I can read it and try to translate it. It says, the value of the real assets of an enterprise has to be higher or the same than the value of the liabilities of the enterprise in the worst financial situation possible. So every financial asset that has a little bit of risk, even if it is just 0. something percent. So, for example, all the loans that you give, they cannot become money. They cannot. They have to be valued at 0. They cannot be taken into account because in the worst financial situation they will be default. So this simple rule is incredibly amazing in order to solve this monetary creation by the private sector that is the root cause of all the financial crises that we are dealing with right now in the world, and all this hypertrophy of the financial sector that is kind of killing the real economy and killing also the planet and having all these democratic problems all around the world. So it's a simple way, and it's a, I think, very robust way to really change the core, at least a big part of the core problems of our time, and it's worth considering. So that's it for this video. I know it's kind of hard, but thank you. I hope you could follow me to the end, and thank you a lot for your time and patience. We are still here in order to keep understanding the question, and I invite you really to participate in the movements that are right now all over the world trying to think and propose solutions to reform the monetary system. If you have, for reference, I would say that the International Movement for Monetary Reform joins together much or many or maybe most of the organizations that in each country and in each part of the world are working on these questions. So I invite you to really to get in contact and to try to ask whatever you want, and we are going to host regular meetings where we, for new members and for new people that are interested in the topic, to share their passion and to share their views and to ask whatever they need and to have fun, really, because it's also kind of fun to understand all of this mess. So that's it. Thank you for watching, and see you in another video. Have a good day, or night, or afternoon, or morning, whatever.